Hello, my name is David O'Kelly. You're very welcome to KPMG's Capital Ideas podcast, the podcast where we talk to investors in Irish business. Today, I'm joined by Peter Garvey, a founder of Melior Equity Partners. Melior aims to invest between 10 and 30 million in Irish businesses. Peter, you're very welcome to the podcast. Can you tell me about the types of deals your funds want to do?
Hi David, and it's nice to be here. So Melior focuses on growth capital investments in Ireland. We tend to partner with founder owners or management teams who want to bring in an institutional investor to help them accelerate the growth of their businesses. As you said, we invest in between 10 and 30 million. We tend to invest in profitable companies, so generally they're making anywhere from 2 million and upwards. We invest across sectors, and the common theme, I'd say, David, is that there is this management team that want a partner, they want help, plus capital to help them grow.
And that term partnership and the founders and management, that could be two different people. Do the founders usually stay involved, or do they take their money and go?
In the vast majority of deals that we do, David, the founders do stay involved. What you find is a founder may have grown their business from nothing over 10, 15, 20 years. And they've reached a stage where they'd like maybe to de-risk themselves a little bit, take some money off the table, but still see a significant growth opportunity within the business. So what they like to do is to take some money out, but also then reinvest alongside us. And that's important for us because oftentimes founders own customer relationships, employee relationships, regulatory relationships, whatever it may be. So that founder access is actually very important for us. What we do with founders then is discuss what their ambitions are. Oftentimes a founder will say to us, you know what, I'm happy to roll proceeds, but by the time you exit in 5 or 6 years' time, I'd like to exit with you. So we work closely with a founder to manage a succession plan over the period of our investment.
And do they tend to be a small minority? Are you the biggest shareholder afterwards? And kind of who's calling the shots? Who's running the deal?
There's absolutely no fixed rule. What I would say is that we are active investors, but we're not managers. So we back great teams to continue to run their businesses, and we support them to do that.
And tell me about management in those deals. Like, how do they get cut in? How does it become meaningful for them?
So in every deal we do, David, we create what's called a management incentive plan. Private equity is all about alignment. In every deal that we make as Melior, our team invests in those deals. So we like to create that alignment of incentives across the whole piece. So the management team will be part of that management incentive plan. They'll invest alongside us and the founder in the investment, so they'll benefit from any value creation within the company.
And a lot of management I talk to, they worry about having to, say, get a second mortgage on their house or personal guarantees. What sort of size is that investment? Is it a huge amount of money, or how do you structure that?
It's a great question. What we want to do is to make sure that the right people can invest alongside us. So what we do is we make the management incentive plan affordable and structure the investment in a way where we can get that wide participation that we believe really creates value. So anyone in the company that has a material ability to add value to the investment, we want to have invested alongside us. So we do make it affordable. Yeah.
Okay. No, good. And so Melior is, I guess, the second fund you've run in the Irish marketplace. What are you and your business partner Johnny Cosgrave? What are you trying to achieve with Melior?
Yeah, so as you mentioned, Johnny Cosgrave and I started Melior in January of 2020, and we had been investing an Irish-focused private equity fund for a large US private equity firm called the Carlyle Group for the previous 6 or 7 years. And in that time, we'd made 11 Irish investments in the likes of the AA Ireland, Payzone, Carol's Meats, the City Bin. And we'd made quite a good fist of it. It was quite a good fund. And Johnny and I saw the continued opportunity to invest in Irish SMEs and help them grow. So we were fortunate enough to have a set of investors from the first fund, including the Carlyle Group and the likes of the ISIF, who wanted to support us to continue on and execute that strategy. So we went ahead and we raised 160 million from some Fund 1 investors, but also some blue chip new investors. And actually more than half the money comes from international investors. And really what we're trying to do is the same again, to find great partners, great Irish businesses that have ambitious teams that want to grow.
And I saw on your website you have a number of senior advisors, some of whom I know very well. What's their role? Did they get involved in the investment or in running the company? What do they do for you in the company?
So David, what we're trying to do is make sure that we can differentiate ourselves versus other pools of capital out there. So in Melior, what we think differentiates us versus others is a few things. So one is we're local. Our team are all based in Dublin. They're a highly experienced team with a great track record. So we believe that we have the best local team in the market. The second thing we've done is we have put a pool of senior advisors around us. So we've got 7 individuals who run some of Ireland's biggest and best companies. And the idea there is that when we invest in a company, that we can bring really great sector insight to bear on our portfolio companies. So the idea is that these people will help us with our due diligence, but then once we make investments, go on the board of the portfolio companies, or even help on an ad hoc basis to add value to those companies. The third thing that we do, and we think differentiates us versus competition, is our international access. Johnny and I and our team have all worked in the international community for decades. We also have a unique access and partnership with Carlyle that persists in this fund. Carlyle, as I mentioned, are investors in our fund, as are the founders of Carlyle. So any company in Ireland that wants to expand overseas that would benefit from an international network, we bring that to bear as well. So it's a combination of local, really great sector expertise on the ground and an international angle that we can bring to portfolio companies.
And the listeners to our podcast here, they're going to be very interested in kind of the numbers and types of deals that you've done. So in this fund, how many deals do you expect you'll do?
So the fund, as I mentioned, David, is 160 million euros. Mm-hmm. We expect to do somewhere between 10 and 12 investments. So okay. As I mentioned, investment size range 10 to 30 million. And again, we're not fixated on a number. Somewhere around 10 to 12 would be just fine. We did 11 in the last fund.
Yeah, and 3 deals done so far?
3 deals done so far, so we're off to a good start. We made our first investment back in last August in a niche insurance broker called BHP. Mm-hmm. It's a really strong business. I have some good experience from chairing our investment in the AA Ireland in the first fund, which was a successful deal for us. So I like the space a lot. There's been a lot of activity in the space, as you know. But BHP, as I said, it's a niche player run by a fantastic lady called Martina Westphal. We've made some really good strides in that business over the last year. We did an acquisition straight out of the gate of a business called KMW, and we're in the market for more acquisitions and going well, touch wood, so far. The second investment that we made was quite a different business, a software business called Salmon Software, which is offering software to the treasury management space. Another founder-owner investment where we partnered with a guy called John Byrne, who again wanted to bring in an institutional partner to help him turbocharge the growth of his business. And Johnny led that investment for us. And then the third investment... So
he's on Salmon, the founder will stay. John will continue to drive the business.
The founder is absolutely along for the journey with us.
Right. Okay. Good.
And then the third investment is a business called Rose Confectionery, which we completed there just at the beginning of July, partnering with a gentleman called Richard Kennedy and his team. It's a more traditional business. It provides confectionery and freeze pops and snacks and nuts to both Ireland and the UK market.
So each of those businesses clearly, leaders in their space. They know what they're doing. Very accomplished companies. Otherwise, you wouldn't have invested. In terms of what you're going to bring to the table, is it an ability to expand by M&A and identify those opportunities and build out the strategy? Tell me about the investment process in the first 100 days of these companies.
Yeah, it's a question we often get asked, and just to say and reinforce the fact that we're not managers, we're active board members, and it's important to say that because a lot of companies that we meet aren't familiar with private equity, and it's a relatively new concept in Ireland, and a lot of what we're doing is just explaining how it works. So really what we're doing is we're trying to create the conditions for growth within a business, and we do that in 2 ways. I've already talked about alignment. we think alignment is absolutely key. So during our diligence process, we create a plan with management that we all stand behind, and we say in 5 years we'd like to go from X to Y. Obviously along the way there'll be bumps and there'll be changes and we'll have to pivot, but we all align behind the one plan. The second thing that we do is we try and create confidence. You often find that founder owners or management teams with a different shareholder structure run their businesses in quite a risk-averse way, and decisions which we would think would be relatively obvious to some founder owners would feel like a risk too far for them.
I've seen that a lot, where the family's wealth is tied up in the business. Every decision becomes a big decision.
Absolutely. And we used to be concerned, David, that when we allowed a founder owner to take some cash off the table, that they may become distracted and not focus on the business. And in fact, what we've seen over the last 7 or 8 years is that once a founder owner de-risks themselves, pays off the mortgage, puts the money in the bank, they actually come to work on the Monday morning and it's, let's go. What do we do now? And the ambition level really spikes up. And our job is to help create that confidence to make investments around people, around production, maybe do some M&A if that's where we can create most value. The other thing that we're trying to do, David, as well, is to try and help teams prioritize. We find in relatively small business and medium-sized businesses that we invest in that you have relatively shallow management bandwidth. You don't have 100 people managing the business. You've got less than 10 in the main. So you have to help prioritize. And what we're trying to do is find the 3 or 4 real key drivers of growth that can make the most difference.
Yeah, it's interesting. I often see with privately owned businesses that sometimes they've struggled to attract additional people to the management team. Over investment periods, does the management team tend to expand? Do more people come on board?
Yes, oftentimes in diligence, David, the founder or the CEO will say to us, you know what, I've identified a gap. I don't have a finance function. I outsource my finance function. I don't have a sales team. I'd like an international sales team. I'd like some really strong people brought onto my board. And our job is to help them attract, find and identify the right people for the team. And that's crucially important because, again, as I say, we're not managers. The management team have to deliver the plan. So what we're trying to do is to reinforce the team. And then as we grow, if a business has grown to double and triple the size that it was when we invested, clearly it's going to need more management. And in a lot of the businesses that we've invested in, you'll see a management team that's grown from 3 or 4 people at the outset to a dozen people by the time we exit.
Yeah, and you're obviously you're an investor. There's a 5, give or take, 5-year investment horizon. It might be longer, it might be shorter. What are the northern lights that you have through that investment period that you're looking to see that the business? What attributes are you looking the business to have by the time you get to the end of the 5 years?
Yeah, so generally the business that we invest in are not perfect, and no business is ever perfect. And even when we exit, they're not perfect. So there's a number of things that we're trying to do. First of all, we're trying to make sure that the businesses grow, and what we want to show is by the time we exit that the business has doubled or even tripled in turnover in that time period. The other thing that we're trying to do is to help the business work on becoming best in class. And what we do based on 25 years experience is that we know what good looks like. And if we don't know what good looks like, we'll find out. And we work with the business to say, you know what, you're getting your supplies from X country at X price. That appears, the wrong thing to do, and would you ever consider doing this? Or you know what, you're selling most of your goods to a half a dozen customers. Over time we need to diversify that because that effectively brings risks onto the business. Or you know what, your team aren't incentivized properly and you need to change your pay and benefits plan to actually make sure that people are incentivized to follow the right behaviors. So we do a lot of stuff around the growth of the business, the operations of the business, the people side and management of the business, because when we show up trying to exit something in 5 or 6 years, the next buyer is going to go through the same diligence process that we went through, and they're going to find the same things. And the onus is upon us. The onus is upon us, David, to make sure we fixed all those things by the time we get through our 5-year investment cycle.
And do you tend to use a lot of debt through that period?
The level of debt we use really varies. As a growth capital investor, it's not a huge part of what we do. The larger private equity funds around the world who are doing big leverage buyouts, a lot of it is around financial engineering and putting a lot of debt in the capital structure. For us, we use relatively little debt. In some instances, we use no debt. And it really depends on, I'd say, the maturity of the business, the growth profile of the business, and the cash characteristics of the business. And we'll find the right debt structure to facilitate that business.
Yeah, and glad you mentioned the large private equity funds. Like when you hear these, multi-billion deals, you talk about, you hear kind of very large cost-cutting initiatives and so on. Does that form part of what you do? Does it tend to be, trimming the fat and kind of maximising profitability over a short period of time?
Yeah, David, I'd argue today that even the large private equity funds, that financial engineering that was, the real source of value creation 30 years ago is no longer what private equity is about. So whether it's a large deal or a small deal today, I think any manager who invests needs to make the company a better company over the life cycle of their investment. So I would argue even at the upper end where people are deploying large amounts of leverage, they're still working very hard to grow the top line of the business and to grow the profitability and the cash flows of the business. In our particular instance, no, we're a growth capital investor. For us, we're not a turnaround investor. We're looking at businesses where we see, as I said, 3 to 4 levers of growth that can fundamentally accelerate the growth of the business over our ownership period.
Yeah. One of the questions we frequently get asked by owners and management teams when we say, look, you should really be talking to private equity and it's a valid and exciting option for a business. It's just like, well, how can they pay as much as a trade buyer? Do you have views on that?
Yeah, and I think, David, as you know, having been doing this for a long time, every owner of a business has different ambitions from a particular transaction. I would say if an owner just wants the highest price and wants all their money today and they just want to be gone, private equity probably not the right option for them. What we want to do is we want to partner with founder owners and management teams who maybe want to take some cash out, and as I said, we're absolutely fine with that, but fundamentally believe in the growth of their business. And what we offer is effectively 2 bites at the apple. You can make some money today, you can put that in the bank, but let's go ahead and double the triple the size of the business and let's make 4 or 5 times our money on the next deal. And for a founder owner, that can be really compelling. A lot of people are working a lot longer these days than they were before, and someone in their 50s and even 60s often don't want to walk off into the sunset. They want to work with the business that they've grown from nothing, and they actually like the reassurance of having a partner sitting beside them and are quite excited about rolling on. So it really depends on what a founder owner and a management team want.
Yeah, I think you and some of the other funds who are early into the marketplace have done a great job just kind of educating the entire Irish business community around the benefits of private equity and how you can, I guess, maybe take some money off the table and go again. But I suppose people are also maybe a little bit wary, very sophisticated industry. Are there, like, what are the bits that people should be concerned about with private equity, the T's and C's that people don't, the terms and conditions that people don't really like or don't want to see in the agreements? Yeah,
and Dave, you're right. When we started investing in Ireland with Carlyle back in late 2013, early 2014, a lot of what we had to do was to educate the market. There was a perception out there that private equity was all about big funds that had done lots of property deals, and people didn't really understand what corporate private equity was about. And we spent the first couple of years doing things like this podcast and radio interviews and TV and presentations, educating the market and frankly the advisory community on what we wanted to do and how the model worked. We've now had numerous successes in the first fund, and other funds of the market have done the same. So I think that understanding of private equity has really increased over that period of time. And for us, that battle of trying to explain what private equity does is kind of over, and that's great. There is, as you say, lots of T's and C's around a private equity investment. What you'd normally have is what's called a sale and purchase agreement, which effectively says I will sell you the shares and I will buy the shares from you. And then you'll have what's called a shareholders agreement. And the shareholders agreement really outlines what will happen when we work together over the next 5 or 6 years. And it's important that anyone who's entering into an agreement like that gets proper advice, both financial and legal advice, and everyone that we deal would do that. But really, David, what I'd say to you is that we're entering into a long-term partnership with management and with founders. And the last thing that we want to be doing is pulling the shareholders agreement out of the drawer. And frankly, because we're not managers and we're absolutely reliant on management teams to run the business, if we're doing that, we're finished. So, you know, we work very closely with our teams. We align ourselves around a plan, as I said. Things do go wrong, and you have a grown-up conversation, and you try and fix it. And that's what we do. And, you know, we are only focused on the Irish market. We have one reputation. We've built that very carefully over the last decade, and we want to be good partners. And we've got 14 management teams around the countries who vouch for that, and that's really powerful for us. So we really work hard to make sure that we work through the issues as they arise in a fair way with our management teams and founders.
Yeah, I tend to agree with that sentiment. For all the time that's spent negotiating these agreements, they very thankfully very rarely get pulled out and used. And ultimately, kind of chemistry and the right partnership is the core arbiter of how
David, it's absolutely the most important thing. Dealing with people that you like and respect in a respectful way, and building that relationship. We spend, you know, months doing due diligence, and a lot of that is on the company and the financials and the legals and the customers, but at least half of it is on the people. Do we like the people? Do we think they're honest? Do we think they're good at their job? And do we think they're going to be good partners? And if we can't answer yes to all those questions, we won't be making the investment. But stuff does happen, right, David?
Yeah.
And that's absolutely true. Not every deal is perfect. And I would say every deal has a bump. And the way I say we distinguish ourselves is how we deal with those bumps. And thankfully, as I said, so far, you know, we've managed to maintain really strong relationships with all the teams that we've dealt with.
Yeah, thanks, Peter. We're in an interesting time at the moment. How are you seeing, you know, deal flow? What's your thoughts on the M&A environment?
Yeah, I think there was a big, I'd say, dip in deal flow in the beginning of that COVID period around kind of second quarter of 2020. That rebounded strongly in the latter half of 2020, and then 2021 was a record year. 2022 is a little quieter. I think a lot of deals have now been done, but certainly from our perspective, having done 2 deals this year already and looking at our pipeline, there's plenty for us to be doing. So we still feel very positive about the M&A environment. Clearly there's external factors at play, and you know, there's macro factors around Ireland's growth and inflation and all those aspects that we consider in every deal that we do. But frankly, we're micro investors, and we look at, is it a good business? Does it have good economic characteristics? Is there a good team? And is there a plan which we think can get us to double and triple the size of the business? And if we believe in that, the macro factors are sort of external, and we're backing our teams to be able to manage them.
So still very much open for business, looking to do deals?
Very much open for business. As I said, we want to do 10 to 12 deals. We've done 3, so we want to do another 8 or 9 in the next 3 or 4 years.
Yeah, okay, no, great. Peter, we've known each other a long time. For the benefit of our listeners, what brought you to the point of founding Melior? Can you maybe give us a sense of your career to date and what you did before your Irish investments? Yeah,
so David, I've been now working for over 25 years in a broad set of areas, all of which I think added up to allow me to build the toolkit to really build then a career in private equity. So started off in Trinity in Dublin, joined KPMG, ended up in corporate finance there. So really started my deal knowledge back in KPMG back in the late 1990s. Went to London. I worked in leverage finance, so lending to private equity deals. I then joined McKinsey, so traveled the world dealing with some of the biggest global firms on lots of different problems and learning from really wonderful people in McKinsey. I was fortunate enough then that a colleague of mine in McKinsey was working for Goldman Sachs in their private equity group and asked me did I want to join there. So I joined there in 2007. Spent 7 or 8 years there working on some really interesting private equity transactions. And then I got a call in late 2013 from Carlisle saying, listen, we've raised money for an Irish fund. We're looking for a couple of Irish people with deep international private equity experience to come back and run that fund for us. And Johnny and I both came back to Ireland in early 2014 to start investing in that fund. So it's kind of a bit of a checkered history, but lots of different elements building up to what I say, what we're doing today. I spent then 6 or 7 years with Carlisle, and I explained the opportunity then to launch Melior in early 2020.
And the move to running your own business, your own fund, as opposed to being effectively the Irish office of an international fund, what was the driver behind that?
I guess it was belief in the market opportunity, David. Johnny and I firmly believed that we'd done all the hard yards from 2013-14 in building a knowledge of what private equity was. We'd built a great track record. We'd managed to build a great team. And we saw the future opportunity for private equity in Ireland. So it seemed obvious to us. Now, the entrepreneurial journey of actually starting your own business and all that goes with that is a challenge.
Yeah.
And myself and Johnny, I think, have learned more over the last 3 years than we've probably ever done in our career, and we're always learning. And I think the great thing now is that we have 160 million euros of a fund. We've got a team of 10 people. We've done 3 deals. The track record of the old fund continues to be very strong. So we feel like we're in a very good place now.
You've 20 odd years in a deal environment, or potentially a little bit more. You've seen a huge number of deals. What are before we wrap up here, what are the common mistakes that people make when they come to you with their business? What are the things they could do differently to just help a deal or help maximize?
Yeah, I'd always advise owners of businesses to do 3 things before they even think about coming to us. And one is think long and hard about what they want. So, do they want to take all their money off the table? Do they want to combine with an institutional partner like ourselves? What is their ambition for the next 5 to 10 years? And people need to have those hard conversations with their partners, with their family, with their friends, to really work that out. I'd say the second thing is prepare. So look at your business. Fix the obvious things that can be fixed. Look at your team. Make sure you have a strong team around you and make those hard decisions around your team. And then the third thing is hire a good advisor. We have this nirvana in private equity of the proprietary deal. But in my experience over 25 years of doing this, proprietary deals are very, very difficult to get done. And deals are difficult, diligence is difficult, and you need an advisor as a business owner to help you get to the right place. And we find it very hard to do proprietary deals because they just take so long. Generally, business owners are very underprepared, and an advisor can really act as that conduit between us and the business owner and help us get to a good deal for everyone at the end.
I think most people who aren't involved in deals on an ongoing basis are amazed by the amount of work involved and how consuming it is, both time consuming and emotionally consuming. That it's a very, very demanding process.
It is, David. Listen, this is often the biggest decision, the biggest deal someone will ever do in their life. And if you've invested 15, 20, 25 years in your company, you want to make sure you're getting good value for the business, first of all. But most importantly for many founder owners is that they're finding a good home for the baby that they've grown over time.
Yeah.
And it really is an emotional roller coaster. And I think the other thing that people don't understand is that as an institutional investor, there's just certain things that we have to do in our due diligence. And every institutional investor will be the same. And it is hard work and it does take time, but we try and do it in a measured way, in a commercial way, and really focus on the big points. But as we're doing it, really importantly for us, and a lot of management teams feed this back to us, when we do our due diligence, it's actually value additive to the company. So as we're building the plan, we're saying, you know what, we've found out that there's 3 things that you don't do very well, or there's 3 things that you do really well, and we need to do more of them. So we try and make our diligence valuable to the team. We show them all the diligence that we get done during the process, and then we use that to really build a strategy for the next 5 years.
Makes a lot of sense. And are there common items coming out of diligence that stop you doing deals that, had they been dealt with beforehand, might have led to an easier deal process?
I think there's always things in deals that come up, David, and our job is to try and box them off and risk mitigate them. So things like, the market. We should know before we go exclusive on a deal whether we like the market or not.
Yeah.
Things like the financial position of the business. Clearly, if a business owner has presented a set of financials that end up not being accurate, that can be an issue for us. And that's why I'd say get a good advisor who will tire kick the projections and the historics that you put in front of us. There's always a legal issue with a contract or a customer or something, but generally they're manageable, David. But know that every deal has its own particular issues. Our job is to find a way, if we like the team and we like the business, to be able to execute on the deal and mitigate those risks. And we work very hard to do that.
Peter, can you tell me about your favourite deal?
Dave, that's a very difficult question. Lots of favourites over the last 15 years or so. To be honest with you, I've enjoyed all the deals that I've been involved in. There's been different challenges along the way in some of them, but I've learned so much from every different situation. In terms of favourites, I don't really have one. Ones that spring to mind. I was fortunate enough when I was with Goldman Sachs to get to know Donal Slattery.
Oh, right.
And when Donal was raising capital for Avalon initially, he'd raised almost $1 billion from the likes of CVC and Cinven, and he had a very small gap in the capital structure, and he called me up and asked would I be interested in investing. So he got on the plane the next day and made a very strong pitch to me in about an hour in Goldman Sachs offices in Fleet Street in London, and I was absolutely blown away.
Well, there's a deal. Yeah,
he was clearly a domain expert and was so passionate about what he wanted to do. And I came out of the room and said, I'm absolutely convinced we should do this deal. The only caveat was that he said, you've got 10 days to do it.
Wow.
So I went off and managed to get it through the investment committee and make that initial investment in Avalon. And Donal did everything that he said he'd do, and himself and his team made a tremendous success of that and generated a very strong return for us. But then it's been great for me to be able to sit back and watch what he's done over the last 10 or 12 years and grow Avalon into, I think, the second or third largest aircraft lessor in the world, and to know that I've been a tiny little part of that. I think closer to home, something like the AA Ireland. And I suppose that resonates with me because, number one, it was our largest deal in the first fund at over 150 million euros, and it was a very complex deal. We had to carve out the AA Ireland from the UK PLC, AA PLC in London, rebuild all the product systems within the business, and it was a very complicated deal to execute on. And we managed to get it done, and then Brendan Nevin and the team there did a really excellent job of transforming that business over our period of ownership, and it turned out to be a very successful deal for our investors as well. And then really, I guess with Melior now as well, having done 3 investments and myself having been involved in 2 of those, really thrilled with what we've done there with BHP on the insurance side and Rose Confectionery on the confectionery side, and really excited about the prospects for those investments.
Yeah. And the AA is interesting because it was another private equity fund who bought it off you. Is that a common feature? Is that is that something you expect to see more and more?
Yeah, in Ireland traditionally, because there's been a lack of private equity investment here, there hasn't been what are called secondary deals where one private equity firm will buy off a second one. I think you're seeing a little bit more of that now, because over the last decade or so there has been some smaller private equity deals done and some mid-sized private equity deals done. So I'd expect that trend to be a bit more prevalent in Ireland over the coming years, albeit for us what we're primarily focused on is what we call primary deals, where we're investing as the first institutional investor alongside a founder owner or indeed in a corporate carve-out as it was in the AA.
Maybe summing up everything you've said over the last 30 minutes or so, Peter, are there reasons why companies should take on private equity?
I think any business out there who has ambitions to grow and to turbocharge their growth should consider private equity. I think with private equity, as I mentioned, you get 2 bites of the apple, so you can take some money out today and you can get hopefully a lot more money out in 5 or 6 years' time. I think the second thing you get is you get a really deep, experienced institutional partner that will be in your corner, that will be a sounding board for you, that has done it before and can help you manage some of the issues that are just commonplace in founder-owner situations. And I think thirdly, if you look at what we and others have done historically, the track record of the funds in Ireland is very strong. And we've done, I think, a really good job in helping Irish founder owners grow their businesses over time. I think we can continue to do that.
Peter Garvey from Melior Equity Partners, you've been a fantastic guest on KPMG's Capital Ideas podcast. Thank you very much.
Thank you, David.